My next guest actually rocketed to Wall Street fame as an analyst. He made a call on Dell. This is back in the day. He said they were going to miss their first quarter of earnings. This is 2001, right? They hadn't missed in 10 years. So after that, he became a legend. They started calling him the Michael Jordan of tech stock analysts. And right now, he's calling for this market, this melt-up, to continue through Thanksgiving. So I want to bring in now Niles Investment Management founder, portfolio manager, Dan Niles. And Dan, when I hear the term melt up, it's sort of like a diss, right? I often hear from folks who are on the other side of the trade, like they're short, but the market's going up, but it's only temporary. Why is this more of a melt up than any other kind of rally?
Well, because you're sitting at incredibly high valuations and they're sort of being ignored. And you're having it really been driven by easy money policies. And so if you kind of look at the makeup of what's going on, meme stocks are back, IPOs are hot again. You've got Bitcoin that had surged above 120,000 to new highs. You've got blank check companies now back, which were the rage in 2021. So you have all of these things that show that there's a little bit of excess building. And then obviously the more fundamental stuff, but that helps fuel this kind of melt up or mania, whatever you want to call it, is things like knowing you're going to get 3 rate cuts between now and the end of the year, which keeps it going. And then the positives of the big, beautiful bill and the tax benefits of R&D and CapEx that comes out of it, which is more long lasting. Right.
And of course, to that point, I guess a lot of folks on the street feel between a rock and a hard place. We saw where the street came out relatively bullish this year. After the tariffs, everyone adjusted for the most part, went much lower. Now the street feels like they're catching up, although I think the average target is 6,200 for the year. You came into the year in cash, which was killing it. And then in April, you said, hey, get ready for a short-term bounce. Well, now this feels a little bit longer than a short-term bounce. You're calling yourself, you've always been a pragmatic bull. Could the rally last beyond Thanksgiving?
Sure, it could, but for me, it doesn't really matter. Whether you think it's a short-term bounce or a long-term bounce, you're still positioned very long. Right. And so we've sort of turned from, okay, it's a short-term bounce to, hey, we thought we'd have good Q1 earnings results. You did. We thought Q2 earnings results will be solid. That turned out to be the case. And so we've sort of stayed with this. And now that you're pretty darn sure you're going to get 3 rate cuts, this market probably keeps going higher, because if you're really thinking out, there's a lot of risks, which is why professional money managers are kind of underinvested, and even retail to some degree. You can look at money market funds, which are hitting all-time record highs, and we're up substantially year over year. So the more it goes up, the more FOMO, fear of missing out, kicks in, the more greed kicks in. And then on the professional side, you've got performance anxiety, right? Nobody wants to get to the end of the year and be underperforming their benchmarks or their peers. And if you've been sort of more pragmatic about it and said, well, we've got tariffs coming through impacting results, you haven't been fully invested. And so this rally has just really caused you a lot of pain. And that's why I think this is a melt-up rally, which is you've got guys performance chasing into year end, fueled by 3 rate cuts between now and the end of the year.
And it is intriguing to have the so-called smart money, the ones who are actually doing a lot of the chasing here. For the last couple of years coming into this year, folks were comparing Nvidia to Cisco for a variety of reasons. I don't hear that as much as I have in the past, but I guess the big question now is that firsthand what that was all about. How much further do you think Nvidia can keep going? How much longer can the magic last?
Well, you brought up a great analogy, which is Cisco. If you look at Cisco, when the first mass internet browser, Netscape Navigator, was introduced in late 1994, Cisco's revenues between late 1994, as you could argue the enabler of internet infrastructure, its revenues went up 15.5 times to its peak over a course of 6 years. If you look at ChatGPT as that Netscape moment, which happened at the end of 2022, it's now been about 2 3/4 years. Nvidia is going to report their quarter soon. Revenues will be up about probably 8x over that period of time, not 15.5x like Cisco saw over 6 years. And so I think you've got a lot more room, because you had this big training phase that happened. You went through kind of a lull at the end of last year as, people, we don't care about training, right? You and I want answers on ChatGPT or Gemini or whatever. We don't care what they're training with. Now, inference demand has picked up. People are using that more, and you've got the companies now really starting to spend on inference. And so that's the next leg of the spending. And inference spending should be, 10x, let's say, what training spending is over a period of time. And so I think you've still got some room to go if you kind of look at the analogy of the internet. 6 years took for the build out, 15.5 times increase in revenues. For Nvidia, it's 8 times increase in revenues over 2 3/4 years. You should have some more room for this to go. Not to say you're not going to have lulls along the way, right? Nvidia stock went down 49%, peak to trough. We got bullish after that write-off in April, and I think that sets the stage for hopefully a few more quarters at least of pretty strong results.
Dan, as usual, great stuff. Love going down memory lane with you, my man. You're still the best. Thanks a lot. We'll talk again soon.